Now, some people will say there's good debt and bad debt, but that's kind of an error. There's either debt or no debt. Now, those are loans, and sometimes people feel if they have a loan, they have debt. Nope, you have a loan. It might be debt if you owe more than you have. Almost everyone uses the terms wrong because it's just what society's done, and they call everything debt. You know, it's like, what if I called a chair a table? That's super confusing to you. Like, put the mic on the table, and then I see it's on the chair. Like, it's a subtle difference, but semantics matter. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. Garrett Gunderson here, New York Times bestselling author, money nerd. And I've got a team of money nerds because this is Ask the Money Nerds. And not only are the questions coming on askthemoneynerds.com, also on the YouTube channel, we've been getting comments, and you know what we've been hearing a lot about? Mortgages, like how to handle a mortgage. Do you pay extra? If you pay it off, how much further ahead do you get? Or do you have to wait to invest? So I figured, why don't you begin with your first question, and then I'll dive into some of these where people are very passionately telling me, no, this is what I did. And we'll talk about the logic or the emotion.
Okay, this question comes from Pam. She says, if you have debt, is it better to sell your home and pay the debt off with equity, or consolidate your debt and take out a bigger mortgage?
Well, let's define debt first and foremost. Okay. And I'm actually going to draw this one here.
Oh, getting fancy.
Yep. I'm fancy that way. So let's define debt by looking at a balance sheet. A balance sheet just determines what's your assets versus your liabilities. When you have more assets and liabilities, that's that term equity that she just brought up, right? Although it looks like equity, but it's supposed to be acute equity. So it's more assets and liabilities equals equity. So if you had a $500,000 home that you owed $250,000 on, you've got $250,000 of equity, because if you were to sell it, hypothetically, you'd have $250,000 that could come in. On the other hand, what happens if it was the reverse? You've got a home that's only worth $250,000 because you bought wrong, it's a recession, it's a bad area, whatever it is, and you owe $500,000. You actually have $250,000 of debt. Now, some people will say there's good debt and bad debt, but that's kind of an error. There's either debt or no debt. Now, those are loans, and sometimes people feel if they have a loan, they have debt. Nope, you have a loan. It might be debt if you owe more than you have. And so when people say avoid debt like the plague, that can create all this emotion. We're like, oh my gosh, I got to get rid of everything. And if I don't, then I've got this monkey on my back. I don't know how I'm going to get through this. Well, look, if you have equity, you just got to ask yourself, do you have more peace of mind when you have something paid off? But what if you had enough cash in a side account that you could pay it off the next day? Would you feel comfortable? Would you feel like you're safer or that everything's okay? Because I would. But other people would still feel that burden, still feel that scarcity, still feel like I've got to get rid of this. But almost everyone uses the terms wrong because it's just what society's done, and they call everything debt. You know, it's like, what if I called a chair a table? That's super confusing to you. Like, put the mic on the table, and then I see it's on the chair. Like, it's a subtle difference, but semantics matter. And so, look, if you have this and you're losing sleep over it because you have a loan, and because and you're not thinking clearly, and you're stressed out all the time, you're hurting yourself, and you're your greatest asset. So no rate of return, no financial strategy matters if that's really dragging you into scarcity. You've got to protect your ability to feel abundant, to think abundant, to be focused on value creation rather than complete scarcity and preservation. So bring the question up again. What was it? Because I just kind of want to define this first.
No, those are two really good things to clarify. But to come back to the question, if you have debt, is it better to sell your home and pay the debt off with equity, or consolidate your debt and take out a bigger mortgage?
Okay. So taking it out when you get a bigger mortgage, where are you going to invest that is a question. And there's a lot of people during really good times, like when the market's just doing well, they go, oh, this is great. I can earn 10% and I only have to pay 4%. I'm going to be so much further ahead. And then all of a sudden we have a correction. And they still owe money, but their accounts have gone down. And we saw people get decimated during the 2008, 2009, 2010 financial crisis doing that. So it's where you put the money that matters. Now, if you were to refinance that loan, like a mortgage, and you'd pay off high interest rate credit cards, that's going to be a guaranteed savings. You just have to be really careful not to just start spending all that savings, right? Because remember, you still have a loan on the home. So I would be really calculated and cautious to ever pull money out. You'd have to be really clear that you had a high degree of certainty of where that money's going, how it's benefiting you now and in the future. And if you can't figure that out, definitely just leave it as is.
Okay.
All right?
Yeah, I think that answers Pam's questions. Let's
All
get
right.
to the ones that came in on YouTube.
Yeah, here's some of the ones that came in. Someone I talked about, the thumbnail said home mortgage lie. And people get really fired up and don't even watch the video sometimes, because what I'm saying is there's something called a method of how you pay something off, and that's different than your objective. So an objective would be, I want to pay off my mortgage and have no mortgage, right? I would never convince someone that they shouldn't do that. If that makes them feel more financially free, if that makes them feel better about their situation, if that makes them feel more stability and security, I'm not here to say, no, you should always have a mortgage because there's a tax advantage. Who cares about the tax advantage? That should be the last thing we consider. Think about economics and fundamentals first, and then think about preferences, and I wouldn't say that taxes are the fundamentals. They're kind of like the bonus. So a method is, how are you going to get there? So if you want to pay something off, this person said, hey, my home was paid off in 6 years now, and we can fully fund our retirement. Well, I have no problem with someone paying it off, but what if you just pay the bank extra money? See, if you've got this home, and I can really draw these homes. This
nice
really
sketch.
Hasn't changed since how I drew when I was in kindergarten. But, this is a weird roof over here on this side. But so let's say you have this home, and it's got a mortgage of $100,000. So let's say that you double up how much you pay into that every month. So you're only required, let's say, to pay $600 a month, but you decide instead to pay $1,200. Every time you're paying extra, you're getting money in equity in that home. But if you ever get into a situation where you have a cash flow crunch, or you need to get to that money, the bank doesn't want to lend you money if you're in trouble. They like to lend money to people who are in a great position and have strong cash flow. So I like to say it this way: they love to lend money to people who don't need it. If you need it and you're in crisis, they don't want to give it to you. So what if instead of locking it up in your mortgage, you just took that money and you put that into some side account, right? So if you would go to cashflowbanking.com, you can see what one of these side accounts could be. Let's just say that you could get 4 to 5% on that side account. And as long as your loan wasn't costing more than 4 or 5%, you now have access to your cash. You now have the full tax advantage of the mortgage deduction. And once this side account gets enough money, you can take that money and pay off the mortgage. So you don't have to wait 15 years if it's a 15-year mortgage. You don't have to wait 30 years if it's a 30-year mortgage. When this side account has cash, you have an opportunity. So let's look at this just a little bit. If along the way you have some issue happen, you have the cash. You can still make your mortgage payment. If it was all the extra money is locked up inside of there, and now you need the cash, you got to scramble. What if you're 30 days late? That can hurt your credit score. Hurting your credit score means you can't refinance out of it and get so it's kind of this effect where a lot of people get super emotional and they think, I've just got to pay this off. Well, great. I'm just saying, look at the way that you pay it off. Look at the method of how you get to that objective. And the more money you keep in your control, in a safe place, you can maximize tax advantages to shorten the amount of time it takes to pay off, have cash in case there's emergencies or unexpected things, which we're all in store for financial surprises. And you don't have to judge me because I said home mortgage lie. Now, I had someone else that said, no, I refinanced from a 5.5% mortgage down to a 3.5%. And instead of keeping a 30-year mortgage, I went to 15 years and I just paid extra and I paid it off in 12 years. And guess what? First off, awesome. I've been in rooms of hundreds of people and even of thousands of people and say, how many of you got a mortgage and paid it off? And it is this very, very small percentage. And so if they're paying extra, that money gets trapped and now they're in a tough situation. They're putting themselves, their credit, and their home at risk. And that's the main point that I want these people to understand, because, okay, that worked out because over the 12 years, they didn't have any major issue. But then I've had other people say, good that I paid this off in 6 years because then I had a financial crunch. Well, it's good that it was after the 6 years, because what if that financial crunch came during the time you're trying to pay it off, right? Or I have people that even say, how many people actually save and would pay the money? If they pay it extra, they're forced to pay it. Look, everything I teach requires responsibility. I'm not going to make it the dumbed down version for everyone because of the irresponsibility that people face, because people spend more than they make, because people wouldn't save the extra money. And then all of a sudden everybody's getting bad advice or lesser advice because a few people don't get it. Make sense?
Yes, definitely.
All right.
You're emphasizing cash flow, and that's something that is so important, where there's so many unexpected things that happen in life. And if it's tied up in your house, you're not going to be able to take care of things as you as you would want.
Right.
Yeah.
So final point here. We've got cost of money. Cost
Yes.
of money is what rate of return can you either earn on your money
Mm-hmm.
in a long-term, fairly safe way, or what's the highest interest rate you're paying on your money? That's our cost of money. See, we always have an interest cost. Either we pay cash and we forfeit the right to earn interest,
Yep.
or we borrow and we have to pay someone interest. Most people only look at, I borrow, this is what I have to pay, not as I pay cash, this is what I don't earn any longer. So if you know your cost of money, if you could borrow from a bank at 0%, how quick are you trying to pay them back?
Slow as possible.
Right. How much do you want from them?
I want it all.
Right. And the thing is, if someone's only paying 3.5% and they can earn 4%, they're actually slowing paying that off if they pay extra to the bank rather than pay it to themselves, earn the 4%, then when it accumulates to enough, write a check in one fell swoop and pay that off, being safer along the way.
Okay, we have another question. This came in from YouTube from Eric. So I have a 30-year with 14 years left at 5.875%. I've been paying $500 extra. Would I be better off saving the money in a taxable brokerage account and hopefully earning something like at least 10%?
Okay.
What are your thoughts for Eric?
So my first thought is on the taxable brokerage account, that's a firm no. That's a firm no because 5.87%, let's look at refinancing that. That's a high interest rate. And I think there's an opportunity to get that interest rate lower.
What is considered a high interest rate? I mean, for some
just
people,
depends
5
on-
probably feels pretty low.
Yeah, but we're just in a time where people are getting in the 3s and 4% ranges right now on mortgages. So
that's significant.
It makes sense to refinance. The other thing is paying extra. I'm going to give that a no as well. All right. That says no on here. It looks like a W, but no. Okay. And here's why. When we're taking $500 extra and putting it in per month, this is how much it lowers the payment. $0. It still requires the same payment the next month because it's an amortized loan.
And what is that?
So an amortized loan, if let's say we have a $100,000 loan, right? And maybe your required payment on that is $600 a month, for example. When you pay $600 a month, it's required until that loan is over, whether that's a 15-year, whether that's a 30-year loan or whatever type. But then in the last payment, it's all paid off. See, if it was a line of credit, let's say this was a home equity line of credit at $100,000. And let's just say, for simplicity's sake, they're charging you 5% on that. Okay? So you have a $500 payment as far as interest only. So if you pay extra, if you pay anything extra, it actually lowers the balance, and you're only being charged interest, and your payment's calculated based upon that. So if all of a sudden you paid it down like $5,000 one month, now you're only being charged $95,000 for that required payment. So you've actually lowered your payment, right? So your payment's now going to be, it's lowered it just a little bit because it's been paid down. So maybe you've saved a couple bucks that month. Whereas in an amortized, yes, you have a lower balance, but the payment is still required off the original loan. So even though the balance on both of them are going down, if you're paying extra, only the line of credit, only the interest-only loan is actually lowering what's required to be paid. On the amortized loan, they're just shortening the amount of time that you have to pay it.
Got it.
Right? So that has a declining balance, but not a declining payment, where a home equity line of credit has a declining balance and a declining payment. So it can lower the amount of time that it takes to pay, but it also can lower the amount that's required to be paid. So that's why I don't like trapping money or paying extra to the amortized loan. So what if we took that $500 and went to a site like cashflowbanking.com and had a meeting with them and looked at what happens on a guaranteed side when you put money in that, if you would pay off the home sooner or if it would take longer, like actually looking at keeping that money in control. And I like the question he's asking, and maybe even reconsidering that refinance and lowering the interest payment, and looking at lengthening the loan so even more can go to this cash flow banking account, and then hopefully you can pull the money out of there and pay off the home sooner. So all we're looking at there is on a side-by-side comparison, right? If I have $500, let's say two options. Either option one, I just keep paying towards the mortgage, but my payment stays at the same level, right? It stays equal. It just shortens the amount of time I have to pay because it's paying down. Or if I put in an account that has cash value, if that cash value is earning a similar rate to what I'm paying right now, because he's close to 6%, it may make sense just to, pay off the mortgage. But if we could refinance and get that under 5%, right, 5% or less, then it might make sense to move to the cash value. Number one, there could be tax advantage on the cash value that you're not paying taxes that you are paying in a brokerage account. Number two, there's stability. So anytime you have an earnings in there, it has a minimum interest rate. And if the market goes down, your account doesn't go down. So you're not taking that risk. Three, you have access to the money. It's not like your retirement plan that might be a 10% penalty or issues to get to it beforehand. Number four, you still actually on this, I guess, get the tax advantage of the mortgage by keeping it, right, and paying interest, then earning interest here in a tax advantaged way. Four, you just have a lot more options this way. So for example, in my book, What Would the Rockefellers Do?, I talk about once you've paid off a mortgage, there are access within cash flow banking to actually do something called a reverse mortgage in your later years that brings money in tax-free from your home.
Ooh.
So all of a sudden, we've probably made this act more like a 7 to 10% with tax advantages and everything else. It might feel like 10 to 15% if we can turn a dead asset like a home into something. So anyway, my recommendation is look at refinancing first. And then second, go to cashflowbanking.com, secure an appointment with those guys, and they can kind of take a look at this and see and compare it side by side. But I like the question because you are trapping that money until the home's paid off, stuck inside of equity.
Yes, I love this. This is good stuff. Being a former teacher, financial literacy is very low. A lot of it's not taught in school. So I think this is why your YouTube channel is so important, is because it's educating us on the things that we don't know and that are so important to living a high quality life.
That's why it's important for you guys to ask questions. AskTheMoneyNerds.com. What are you dealing with? What's going on in your life? This is amazing research for me when it comes to the videos we produce, to the books that we write, to really knowing what's happening out there in the world. And I don't look at it like if people ask a question that seems rudimentary or they're worried about it. Everybody is going to have these questions sometimes in their life. We don't all arrive with the money manual, know exactly what to do and how to navigate this. So I appreciate that you have the courage to ask the questions. We're going to give you those answers. And even if people want to argue with me a little bit, that's fine. I welcome the debate. I just want to make sure that we get to the best solutions for the people involved. I don't have a dog in the fight as far as I don't sell mortgages. I don't sell insurance. I don't sell mutual funds. What I do is I'm an educator. Yes, I sell books. And for some reason, people out there think that that's bad. Like somehow if you're an author, you should never charge for that and it should always be for free. If that's you, I'm sorry. I do make a living by selling those kind of things, but I also make a living doing the things that I teach here. So hopefully this has been something you enjoy, and most importantly, that you can transform your thoughts into profits and build the life you love.